Hello and welcome to yet another exciting episode of The Investing Edge. And this week we're going to talk about debt. Well, it's been on our mind for many months now. So let's get the how and why of what's happening in the debt space. With me, as always, is Firoz Aziz, Deputy CEO of Anand Rathi Private Wealth Management. Archana Shankar, who's an HNI investor, and she's been investing for 15 years. So let's talk about her experience as well. Hello to both of you. Firoz, first to you. We had seen a debt market which had almost come to a freeze or a standstill, right? There's some sort of normalcy returning now. What's the outlook here? There's some talk of maybe corporate bonds even being listed, etc. So, what's the outlook for the debt market, especially in an environment where interest rates are getting cut?
See, I think when you have to, of course, like you said, Sumera, debt market over the last couple of months had seen, especially in the month of March and April, had seen significantly low volumes. So it had become very difficult, especially for mutual fund managers, to access capital, which was lent to different corporates. So now, how are things shaping up? I think the liquidity has eased out largely. The shocks which we saw, I think, has triggered a lot of regulatory change, expectation at least, if not fructification of those expectations yet. Third, I think the interest rates have come down. When we speak of interest rates and debt markets, there are three things we have to factor in. One is the interest rate of the short term. The other is the interest rate of the long term. Then comes whose interest rate are we speaking about? Is it government company or government or a government-based PSU or a AAA or a AA? So if you ask me, I think liquidity has become better. Point one. Point two, interest rates in the short end of the yield curve have come down significantly. On the third one, which is the spreads, I think that's eased out as well. So things are looking much better than they were a quarter before.
Okay, but what about corporate debt specifically? I mean, a lot of deals are taking place. Do you think, it's overvalued, undervalued? What's your take?
See, corporate debt, most of it is corporate debt, AAA, AA. Now, if you look at corporate debt, then you look at spreads. For example, if government borrows, it borrows at the least rate. Then are the PSUs. The spread between PSU and government paper, which is a 10-year paper, historically has been 0.5%. Today, it is close to 0.8%. So that's an indication of a little stressed debt markets, marginally stressed. Then comes the AAA. The AAA corporates borrow at 1.5% historically, greater than the 10-year paper of Government of India, right? So that's the spread between Government of India borrowing and the AAA. Then comes Government of India and AA. That has been, to my mind, 3 to 3.25%. Anytime when the spreads compress, by which I mean if AA corporates are able to borrow closer to Government of India, the spreads compress, then there's overvaluation. To answer your pointed question, to Sumera, I think the spreads indicate undervaluation, not overvaluation.
All right. Well, as always, I've learned something new this time. But Archana, let me come to you on this because you've been investing for 15 years now. I'm sure you've tried your hand at everything. How has been your experience with the debt portion of your portfolio?
Being a lawyer by profession, I'm aware of my financial goals, but I am a very conservative and a very low risk appetite. So that's the reason why when I went to Anand Rathi and Feroz, I kind of made them aware of my financial goals and also my expectations out of, obviously we were not aware of the COVID-19 impact and things of that nature. But I think what Anand Rathi actually did was that they helped me execute my financial goals without raising too high my expectations and being reasonable in that sense. So one of the, when I do look at my financial portfolio, my at least 35%, and that would be at least one third of my investment would be in debt. And the reason why I've kind of secured one third in debt, and that's obviously based on the advice of Anand Rathi, is essentially because I'm a low risk appetite person. I don't invest so much in share markets and things of that kind. So when I do have that investment of one third of my portfolio in debt, it just ensures it's it's kind of bifurcated, and it ensures a couple of things. One is obviously it ensures there's a fixed inflow of irrespective of the market fluctuations. So we've kind of got a buffer. When I do that investment, there's a kind of a inbuilt buffer that ensures that you will get some minimum return on your investment. It does reduce the risk because you don't want your principal to be eroded, as in when you're investing in your market. So you really don't want a particular to fall down a particular level. I think the third thing that's very, very important is that, with the kind of market fluctuations that we've been seeing since the COVID-19 March, there has to be a lot of hand holding. And what I say mean hand holding is that there has to be a continuous monitoring and a very proactive way of seeing, how the markets are fluctuating, or maybe even do a bit of prediction. You cannot always be right in your prediction, but a reasonable prediction is what one typically looks at, and that's what's kind of made me stick on into the debt market, because there was a continuous monitoring by the Anand Rathi team, and continuous follow-ups, when to exit, when to kind of exit a particular fund. And just to kind of give you an idea that even before the AMC shut down, we moved out of the Franklin funds. I think that was weeks before that AMC shut down. We from credit risk funds to overnight funds. Honestly, if you ask me what these overnight funds are, I did not know them till Feroz and his team kind of explained it to me very, very lucidly. I'm a lawyer, as I said, by profession. I really didn't know what was the risk associated with it, what is the kind of, what returns I'm going to expect out of it. But as I said, the continuous monitoring and hand holding and kind of speaking the language of your investor is so critical to be able to kind of make those right decisions as an investor.
So that's quite heartening to know. What Archana is, of course, referring to is the 6 managed credit schemes which were shut down by Franklin Templeton AMC. But, Archana, I'm very happy that you're speaking of debt in this fashion, because a lot of other investors are looking to shun debt. So obviously, it's not that there is a problem with the category or the investment vehicle. It's probably, somebody's bitter experience, and you looks like have had a better experience. So perhaps it comes down to choosing the right advisor or the right product. Feroz, in that case, is there a science towards selecting debt mutual funds? I mean, how can we ensure that everybody across the board, or at least a large portion of investors, have a better experience with debt mutual funds?
I think, of course, there's a science. There is a science. Everybody uses some science or the other. But the most well thought out science, which takes care of all the four corners and doesn't leave loose ends, is the most critical. So we have several categories, close to 309 funds. We can't invest in all of those 309 open-ended funds. So separate filters help you narrow down to a group of 5. That's what we do. The first step is we eliminate those categories which don't help us meet the objective which we set ourselves for this constituent of the portfolio. So objective setting is very critical in any exercise. Most of us skip it. We just go straight to the product. So set your objective. According to us, over the next 3 years, the objective of debt should be to give you a high probability 6.5% compounded return per annum. So that's objective 1. Objective 2 is to make sure if interest rates were to move up and down, my portfolio on the debt side doesn't swing as much. So that implies the risk associated with that portfolio. And the third risk, or the second risk and the third point, is to make sure that there's credit events, by which I mean if there's insolvency occurring in certain cases, you should have the least impact or no impact. So these are the 3 objectives, according to which, to my mind, 4 categories out of the numerous in the debt side pass this test. Banking and PSU funds, short-term funds, dynamic bond funds, and medium-term funds. If you stick to your debt portfolio over the next 3 years into these 4 categories, I think the probability of getting that 6.5 could be larger. Sumera.
Feroz, given the recent events, would you say that a fund manager in a debt scheme now, I mean, credit understandably, but even duration would be more important than a fund manager of an equity mutual fund?
I think yes and a no, Sumira. Of course, both monies are critical. Their jobs are different. Uh, if you look at duration, of course, the kind of interest rate fall we have seen, there could be a risk of interest rates going up again, especially in the short end of the yield curve. The steepest fall, we've seen one of the steepest falls in the RBI's repo and the reverse repo rate. So, which implies as things settle down, you could, if inflation comes back, RBI could increase interest rates again. So that's the risk. So to answer your question, Sumira, of course, debt fund managers have to be far more vigilant and agile going forward. That's one. And the debt fund manager's key role of active management has to be understood, that if you buy a debt fund, it has a specific interest rate of the cumulative portfolio. If a fund manager beats that interest rate, then the active management which the fund manager is doing on a daily basis is creating value. So we check the fund manager on this parameter, which is how much more than the interest of the bonds does he make. If a fund has a 6% interest rate today, and if you check its return after 1 year, if the fund gave you 7%, that means 6% was an outcome of the interest of the bonds, which was going to come automatically. And some degree of churning and active management resulted in the 1% more and brought the return to 7%. This 1% is a very precious 1%, and that is attributed to a fund manager's capability of managing all the risks and rewards.
All right, I take your point. Well, we're going to take a very quick break. When we come back, we're going to tell you how you can measure the credit risk in your portfolio. And we'll also talk about a little bit about how the market regulator is moving to make debt funds safer for all. Do stay tuned and we'll be right back. Back, you're watching The Investing Edge. Now, we've spoken a little bit about debt markets, about selecting a debt mutual fund, but what about the funds that you already have? How do you measure how risky those funds probably are and what you should do with them? Firoz, how does an individual investor analyze the sort of credit risk that they have in their portfolios, and how do they know how much risk is too much risk?
See, Sumira, I think if an investor already has invested in specific debt funds, the first thing he needs to know to get a grip on the credit risk of the fund group which he owns is to figure out how much of that money is invested in Government of India paper, step one. Step two, see what's the proportion in PSUs. Third, you can check how much is there in AAA. So if this aggregates to 80-85%, then you're perfectly fine during this unprecedented time. So that's one easy check, because a retail investor might not have access to an advisor like an HNI client. So that's first thing you should know about your fund. The second thing you should know about the fund is what category and how much proportion of your money is in each category. For example, if you have 5 funds and 3 of them are credit risk funds, which of equal proportions, that means 60% of your money is in credit risk funds. By definition, these funds are expected to take companies which might have credit risk, but very carefully chosen by the fund manager to give you that 2-3% extra over a year period every year. So check what proportion is in which category. That's a very important activity. Why is it important? Because it's not just the fund which you should be worried about. Because if you've bought a credit risk fund, the company might not default, but there's huge redemptions which have come over the last 3-4 months. Beginning March first week, credit risk funds have lost almost 70% of their AUM, which implies almost a run on them, which means that even if the companies don't default, several other investors who are your co-investors are redeeming the money in panic. So you don't want to be caught off guard being the last person in those. So 3 things: find out your proportions in each kind of bonds. Second, each category, and be wary of a couple of categories like credit risk funds, especially in the current environment.
Okay, and there are monthly disclosures, portfolio statements, all which come to investors. If you want to check out a scheme which you have not yet invested in, you can find all of these statements on the mutual fund website. So do spend some time going through them. But Firoz, this whole question of even needing to analyze credit risk arises from the events of the last 1 year where there have been so many defaults, etc. Now I understand that SEBI has formed a working group to sort of analyze the ways in which open-ended debt schemes can actually be made safer. Some new regulations, perhaps mandating everybody to keep 10% in liquid assets, or gating redemptions, swing pricing, etc. How wide do you think can be the scope of this? Can it revive the loss sentiment? And what more can they do besides just the very obvious?
See, I think it's very good that the regulator is looking at learning from what COVID had to teach us, especially the shock in the month of March and April. I think it's very important for us to take those learnings and learn that because debt has a very large intersection between retail investor and also sometimes even a corporate investor. So you have the hot money sharing the platform with a retail investor in certain cases, especially the liquid funds and also the overnight funds. Since overnight funds are just a 1 day investment, which the fund manager makes in most cases, so you don't have to worry. So, point one, I'm making SEBI going forward, looking at making more safeguards for the debt investor can definitely revive the sentiment. Second is, I don't think most debt investors, especially the HNI category, if I have to speak on their behalf, have not too many choices other than the debt funds. Because if you go outside the debt fund, the taxation could be as high as 42.7%. So I think the sentiment could be bad, but I think the fund manager or the investor is still compelled to use the tax efficient platform of the debt mutual fund, is why you don't see it slipping, the assets slipping for long periods of time. I think gated redemptions is a very good solution. Preparing for a shock of redemption for the fund manager is definitely a very, very good solution. I'm sure SEBI would come out with more crystal clear guidelines for the debt fund manager community to not be in the same spot as they were way back in March.
Okay, so this committee will, of course, submit its recommendations to SEBI. But Archana, the final word to you, since you spoke about debt as having had a good experience. Why don't you tell us what has been the best product from the debt space within your portfolio?
So, Myra, just to begin with, I was introduced to a structured product by Anand Rathi, and to be absolutely honest, I didn't actually even know what structured product was. I was kind of talking pretty much in credit and debt funds, things of that kind. But when I was introduced to structured products by Anand Rathi, I just thought that was one of the best decisions and choices that I made in the debt space. And why do I say this? I think, as I said initially, that I do have a low risk appetite, and at the same time, I do want to protect my principal amount. So the structured product actually kind of fitted completely into the criteria that I had outlined, or basically my financial goals. So what does it do is it kind of reduces your dependence on the market. So the volatility that you have in the market is kind of taken care of with good returns. There are twofold benefits. One is obviously there's a reduction of risk associated with the changes in the market. There's an increase in probability of generating higher returns, even when there's a nominal movement, not a very high or low movement of the market, but nominal upward movement. The probability of having a higher returns is better. Maybe I would just add a third is that you always have a downside principal protection, which means that there's a minimum point below which your principal will not be eroded. So these were the couple of things that kind of I found structured products in the debt space as being one of the best choices that I've made. And just to kind of give you an example, that when the Nifty eroded by almost like 26%, my debt portfolio kind of had an upward movement of 8.9%. So like approximately 9%. So this is the kind of investment and advice that I always look for. And if I'm introduced to new products, structured product would certainly stand out.
All right, Archana, good to know that. Thanks very much for sharing your experience. Firoz, thanks also to you for advising our viewers as always. With that, we've come to the end of Investing Edge, but there's still a little bit more left for you. If you're looking for new mutual funds to invest in, well, here's Chetan Shenoy, Head of Product and Advisory at Anand Rathi Private Wealth Management, who's narrowed down one such fund. Thanks for watching.
Yeah, I'm here to talk about the ICICI Prudential Large Cap Fund. It is called ICICI Prudential Blue Chip Fund. It is a large cap oriented scheme, and as per the SEBI categorization, it belongs to the large cap category of schemes, which means that it has to have 80% of its allocation allocated towards large cap stocks. As of June end, the AUM of this scheme is about 22,800 crores. And as far as fund managers of this fund is concerned, it had seen a change in fund manager about 3 years back. But since then, they've had a dual fund manager strategy. So currently, they have two fund managers since 2017. One of them joined them in 2017, joined the fund in 2017. The other one joined in 2018. The fund manager's name is Rajat Chandak, and the other fund manager's name is Anish Taukle. The fund is well diversified. It has about 60 odd stocks diversified across 10 to 12 schemes, 10 to 12 sectors. So it's well diversified. And true to its style, it has 89% allocation into large cap stocks and about 10 odd percent allocation into mid cap stocks. Now, as far as the Anand Rathi ranking is concerned, we have a ranking mechanism where we rank mutual funds basis a certain philosophy, and the ranking philosophy is based on 6 parameters. First of the 6 parameters is consistency of the past returns. The second parameter is the risk that is being taken by the fund manager. The third parameter is the alpha generation ability of the fund manager. The fourth one is the valuation parameter. And the fifth one is stock picking ability of the fund manager. And the sixth and last one is the return generation ability of the fund as such. Now, based on these 6 parameters, we have ranked the fund 2 out of 5. And the reason why we've ranked it 2 out of 5 also I will explain. In terms of performance, it's been a mediocre performer. It's been slightly below the average performance of the large cap category schemes. As far as the risk is concerned, it's been well managed. Actually, that's a tick in the box, because the risk of the fund measured by standard deviation has been about 19 odd for the last 3 years' time, while Nifty standard deviation has been about 20 plus. However, the alpha generation ability of the fund manager has been very inconsistent. The stock picking of the fund manager has been below average. He's been getting 4 out of his 10 decisions right, which means a 40% right to wrong ratio. We would like to have something which is upwards of 50%. And the valuation of the fund is also more on the expensive side, which means that the future returns is something that is not as good. So therefore, we have ranked it 2 out of 5. Thank you.